Hello friends, you must all have heard of mutual funds, a term frequently used by financial experts. It is now becoming a favorite among investors in order to grow their wealth. Of course, by keeping in mind the market risks. Just imagine a tree with sprawling branches. Each branch offers lucrative investment opportunities, and one branch is mutual funds. In this video, let us understand what mutual funds are, and you will also say, "Ekdam sahi hai." For an investor to manage and grow his or her own funds, it involves expertise, knowledge, and also the need to be constantly updated about current trends in order to get good returns, keeping in mind the risk factors. Of course, can prove to be an excellent choice once you have dedicated some time and have gained the competence to do so. Else it would be simply easier to get an acknowledged expert to do it for you. For example, as you know, we all go to school to learn, and there is one teacher who teaches a class of many students together to fulfill a common learning goal. Similarly, an expert manages a fund created from a pool of savings by a number of investors who all have a common financial goal, that is creating wealth. This is exactly what a mutual fund achieves. Let us now take a look at this in detail. Pool of savings and units. A mutual fund is a trust which pools the savings of a given number of investors who share a common financial goal. Every mutual fund is required to be registered with SEBI, that is Securities and Exchange Board of India, which regulates security markets before it can collect funds from the public. This is mostly done by an asset management company. This pool is broken up into units which are then issued to the investors against their investments. For example, if the market value of securities of a mutual fund scheme is rupees 200 lakhs and the mutual fund has issued 10 lakh units of rupees 10 each to the investors, then the NAV, that is the net asset value per unit of the fund, is rupees 20. NAV is used to track the performance of the fund, which we will understand later in the video. First and foremost, let us now see how the funds will grow. Deployment of funds. The money collected is now invested in a portfolio of securities like equity, bonds, etc., which ultimately reflects the common investment objective of the fund. There are different types of mutual fund schemes. For instance, equity schemes, where investments are made only in equity-related instruments, and debt schemes, wherein investments are made in liquid funds, money market funds, etc. These are a few examples of the schemes where the funds can be deployed. Now let us see the factors to track the progress of the mutual fund. Tracking the progress of a mutual fund. NAV, that is net asset value, is simply the market value of the securities held by the scheme. NAV is updated daily and in general is calculated based on the end-of-day values of the securities held by the scheme. In order to track the performance of the scheme, the NAV per unit of the fund is used. Referring to our earlier example, the NAV per unit was rupees 20. Depending on the gains and losses on this NAV, for example, if the value goes up to rupees 22, then we can see that there is an approximate gain of 10%. Gains, redemption, fees and taxes. The income generated from the investments and capital appreciation is shared by the investors proportionate to the units held by each one of them. The mutual fund is managed by an asset management company that works for the benefit of the investors and in adherence with the mutual fund regulations governed by SEBI. If the investor wants to book profit, he can redeem the unit's NAV in part or the entire amount. This is called redemption. Redemption can also be availed at any point of time, but only for certain types of mutual funds. If one redeems before a certain specified period, then an exit load or a penalty will be levied. Dividend is also another gain that arises out on this investment. Here there is an option to add the dividend amount to the fund or to redeem it. Every scheme charges an operating and management fee called the expense ratio. This can be in the range of 1 to 3%, depending upon the mutual fund type. In addition, there are some transaction fees and transaction taxes which are applicable per transaction. As far as taxes go, the dividend income adds up to the current financial year income and will be taxed in accordance with the income tax slabs of the individual. Short-term or long-term capital gains will only be applicable when the fund is redeemed. Benefits of investing in a mutual fund. Expert management. Mutual funds are managed by professionals. Their core competence involves investments related to mutual funds, and as a result, it could be a safer investment option than investing on your own without the right knowledge. Also, they are well regulated and safe and transparent. Flexibility. Mutual funds give you the flexibility too, wherein you have the option of investing smaller amounts or larger amounts or making one-time investments or piecemeal investments. Liquidity. For certain types of mutual funds, one can easily buy new units and encash units as desired without any hassles. Usually, the amount gets credited to the investor's account in T plus 3 working days. Diversification. Mutual funds offer you high diversification options. The extremely large spectrum of mutual funds, from equity to money market, from local to international market, and so on, ensures that your wealth tree is sure to grow and blossom. These are just a few of the benefits of mutual funds. Well, now you know about mutual funds and its basics. We hope you have learned something new today, as it is our constant endeavor at Motilal Oswal to educate and make an investor a sound investor. Happy investing!
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.